Wall Street. Two words synonymous with global finance, the heartbeat of America's economy, and the nerve center of the world's financial markets. But how did this narrow street in Lower Manhattan, which was once a simple marketplace for securities trading, come to dominate global finance? To understand Wall Street's rise, we must trace its roots through over 2 centuries of ambition, crisis, innovation, and power. Today, we'll explore the story of how Wall Street became the most influential financial hub in the world. Wall Street's journey began in 1792 in the heart of New York City, when 24 stockbrokers met under a buttonwood tree at 68 Wall Street. They signed an agreement that became known as the Buttonwood Agreement, marking the founding moment of the New York Stock Exchange. This was the first formal agreement between stockbrokers to trade securities and shares, laying the groundwork for an organized marketplace. Prior to this, securities trading was unregulated, and prices were often unstable. The Buttonwood Agreement marked the beginning of Wall Street's transformation from an informal collection of traders to the powerhouse of global finance. While the agreement was foundational, it's important to understand why Wall Street was chosen as the location for this nascent exchange. New York City was a natural economic hub, strategically located near the busiest port in the U.S. The port's proximity to global trade routes meant that it was already a bustling center for merchants and financiers to gather. Wall Street, running through the heart of Manhattan, offered an ideal location for these traders, close to the financial and trade information flowing in from around the world. It's from this position that Wall Street would later grow to influence global finance. One of the most important figures in Wall Street's early rise was Alexander Hamilton, the first Secretary of the Treasury under President George Washington. Hamilton's vision for America's economic future was nothing short of revolutionary. Understanding that the young United States needed a strong and cohesive financial system, Hamilton advocated for the creation of a central bank to manage the country's debt, stabilize the currency, and foster confidence among investors. In 1791, Hamilton succeeded in establishing the first Bank of the United States, a key institution in the development of the American economy. The bank acted as a depository for federal funds and allowed for a uniform currency, which made the country's markets more attractive to investors. By creating a solid financial foundation, Hamilton also set in motion the early stages of Wall Street's transformation. Wall Street became the place where bonds issued by the federal government were traded, and Hamilton's creation allowed the fledgling nation to attract the capital necessary to build its infrastructure. Hamilton's foresight didn't stop there. The creation of the first bank laid the foundation for Wall Street's role in financing national infrastructure projects. Early American initiatives, such as the construction of canals and railroads, required enormous investments, which Wall Street was well positioned to facilitate. Investors in Wall Street connected wealthy individuals with companies seeking capital for massive infrastructure projects, helping to build the economy and connecting the nation. The Industrial Revolution of the late 19th century was a defining moment for both the American economy and Wall Street. New industries emerged, powered by advances in steel production, railroads, and oil, requiring enormous amounts of capital to expand. Figures like Cornelius Vanderbilt, Andrew Carnegie, and John D. Rockefeller became household names. But their success would not have been possible without the support of Wall Street. Vanderbilt, a titan of the railroad industry, sought capital from investors on Wall Street to build an interconnected railroad network across the country. Carnegie, the steel magnate, also tapped into Wall Street to fund his expansion of steel production. Rockefeller, through his company Standard Oil, did the same, financing his rise to dominance in the oil industry. J.P. Morgan, one of the most influential financiers in American history, symbolized the growing power and influence of Wall Street. In the late 19th century, Morgan didn't just manage funds, he actively shaped entire industries. Through his firm, J.P. Morgan & Co., he became the driving force behind the consolidation of industries such as railroads and steel. His investment firm facilitated the creation of monopolies, or at least trusts, where one company would control all aspects of a given industry. Morgan's influence even extended into the realm of government, where he helped stabilize markets during times of economic turmoil. His consolidation of the railroads in the 1880s, for example, helped streamline a fragmented system, making it more efficient and profitable. The Panic of 1907 exposed some of the vulnerabilities in Wall Street's rapidly growing power. This crisis occurred after a wave of bank runs, and stock speculation left many institutions on the verge of collapse. Unlike today, there was no central bank to help stabilize the financial system, leaving Wall Street vulnerable to panics. In this moment of crisis, J.P. Morgan once again demonstrated his immense influence. Recognizing the danger to the U.S. economy, Morgan personally stepped in and organized a private sector bailout, pulling together the country's leading financiers to raise $25 million to stabilize the banking system. This intervention helped avert a full-scale financial collapse, but it also highlighted the degree to which a single individual's wealth and power could dictate the nation's financial destiny. In the aftermath of the Panic of 1907, many began calling for a central bank to prevent such crises from happening again. A call that would be answered a few years later with the creation of the Federal Reserve. The 1920s were a period of unprecedented economic growth, but also speculative excess. The decade, known as the Roaring Twenties, saw stock prices soar as investors poured money into the market. At the time, it was common for people to buy stocks on margin, meaning they would borrow money to purchase more stocks than they could afford. This created an inflated market, based more on speculation than the underlying value of the companies themselves. However, this speculative bubble came crashing down on October 29, 1929, known as Black Tuesday. In a matter of days, the stock market lost nearly $30 billion, causing widespread panic and financial ruin. This marked the beginning of the Great Depression, a devastating economic downturn that affected economies worldwide. In the wake of the Great Depression, the U.S. government responded with reforms designed to restore confidence in the financial system. President Franklin D. Roosevelt's New Deal introduced a raft of measures, including the creation of the Securities and Exchange Commission in 1934, which aimed to regulate stock trading and protect investors from fraudulent practices. Roosevelt also enacted the Glass-Steagall Act in 1933, which separated commercial banking, which deals with deposits and loans, from investment banking, which involves speculation, a critical move designed to prevent future crises. World War II not only reshaped global geopolitics, but it also cemented Wall Street's role in the global financial system. The U.S. emerged from the war as the world's dominant economic power, and Wall Street played a crucial role in the country's post-war recovery and the reconstruction of Europe. Wall Street helped manage war bonds and played an instrumental role in financing wartime production. The Bretton Woods Agreement of 1944 solidified Wall Street's new global role by establishing the U.S. dollar as the world's reserve currency. This agreement created an international monetary system where the U.S. dollar was tied to gold, and other countries pegged their currencies to the dollar. This move gave Wall Street access to global capital flows, turning it into the center of the global financial system. In the post-war years, corporations began going public at an unprecedented rate, and the stock market saw significant growth. The rise of mutual funds democratized investing, allowing ordinary Americans to participate in the market. Wall Street was no longer just a place for the wealthy elite. It had become a key player in the financial lives of the middle class. By the 1970s, Wall Street's role had changed again. The collapse of the Bretton Woods system in 1971, along with oil shocks and stagflation in the U.S., led to a period of economic turmoil. In response, Wall Street began lobbying for deregulation, arguing that financial markets should be left to operate freely, without interference from the government. The 1980s marked a new era in Wall Street's history. Junk bonds, a financial instrument created by Michael Milken at Drexel Burnham Lambert, allowed companies to raise capital by borrowing heavily. These high-risk bonds became a critical tool for leveraged buyouts and the aggressive mergers and acquisitions that defined the decade. Wall Street firms like Goldman Sachs and Morgan Stanley thrived in this environment, taking huge risks and creating vast fortunes. However, the rise of computerized trading and new financial instruments revealed the vulnerabilities in Wall Street's new approach. The stock market crash of 1987, known as Black Monday, was triggered by a combination of automated trading systems and panic selling. This crash demonstrated the increasing complexity of financial markets and how quickly they could spiral out of control. The 2008 financial crisis was a wake-up call for Wall Street. The crisis was triggered by the collapse of the subprime mortgage market, which was fueled by risky lending practices and complex financial products, such as mortgage-backed securities and collateralized debt obligations. Wall Street's financial engineers had packaged these risky loans into seemingly safe investments, selling them to banks, pension funds, and global investors. When the housing market collapsed, so did these products. leading to a global financial meltdown. In response to the crisis, the U.S. government stepped in with a massive bailout to stabilize the financial system. The Dodd-Frank Act passed in 2010 aimed to increase transparency and accountability in financial markets, but the damage to Wall Street's reputation was done. Critics of Wall Street argue that its pursuit of profit, often at the expense of the broader economy, is a fundamental problem that must be addressed. As we look to the future, Wall Street faces new challenges and opportunities. The rise of digital currencies, the growth of fintech, and the growing focus on sustainable investing are transforming the landscape of global finance. At the same time, the lessons of past crises should serve as a reminder that greed, speculation, and a lack of regulation can have disastrous consequences. Nevertheless, Wall Street's legacy is undeniable. From its humble beginnings under a tree in 1792 to its current status as the financial epicenter of the world, Wall Street's story is one of transformation, power, and influence that continues to shape the global economy today.